Hello, ladies and gentlemen. This is Christopher Aaron. We will get to looking at the gold and silver action in just a few seconds. But before I do, as is my tradition, I just wanted to give a public thanks. I received this gift, and this is pretty cool. And I don't mention any names here due to privacy reasons, of course, unless someone has a YouTube screen name that I know of, but in this case I do not, so I will not mention any names unless they want to come forward. But I do want to say thank you to this individual, and I just wanted to show these are some hand-poured silver coins. Look at this lion, and on the back here, or the front rather, the rams. This is very cool, and this one, let's see if I can show it properly. We have beautiful bird there with the moon, the crescent moon. Very nice. So thank you once again. I really do appreciate when anyone sends me gifts. It means a lot to me. It makes this a lot more human and a lot more real, and I'm glad to be able to share some of this information with you. Thank you again. Let's get to the metals action. Ladies and gentlemen, good evening. It is the 22nd of June, 2016. Happy summer solstice to anyone in the northern hemisphere of this planet we are all spinning on, and happy winter solstice to anyone in the southern hemisphere. Anyone who pays attention to these patterns around us will also gravitate toward this type of analysis because it's very, very heavily focused on pattern and cycles analysis. We will look at the action in gold and silver again as we get through these summer months, which tend to be slow, but I would encourage you, if you are considering investing in the sector or if you're learning about it for the first time, I would encourage you to use the slow months to make your plan for the next several years. It's much better to do that when there's consolidations going on than when the markets are spiking higher and everyone's rushing in to buy and there's a sense of, oh my God, I missed the move. It is much better to be making careful and calculated moves now during the summer months. So thank you for being with me. Just a quick note for anyone who was interested in the silver trading service that I'm still considering. I'm still looking at that. I'm having to upgrade some of my hardware here on this end. That's taking a little bit longer than I would have hoped. I hope to have that done in the next 2 weeks or so, and then I would be looking at ideally a mid-July time frame for launching that. I do trade silver in this short-term way only. I do not trade gold. I just find that silver is a lot easier to trade. And part of what I hope to do with this service, with my other premium service, is to help people to profit as much as possible. I do believe that we have the need for material wealth. That's not the goal, but it's a means. And I want as many people to participate in what I perceive to be a significant move setting up here, not just now, but over the next several years. And just if you are interested in the silver trading, what I would encourage you to do now so that you can prepare for that would be, you will want to have access to two types of trading vehicles that I will primarily use. One is options. I typically will trade options on the SLV fund. So you would want an account that allows you to trade options on stocks. One of my preferred brokers for that is Options House. I have no affiliation with them. I don't care if you use them or anyone else. I'm just telling you it works well for me. The other account that you would want if you were looking at this sort of thing for when I launch it would be the ability to trade futures or even mini futures. The difference being that futures allow you to trade pretty much 24 hours a day, 5 days a week. And every once in a while, we will close or initiate a trade during the overnight hours. So that's helpful. Whereas with options on the SLV, for example, that can only happen during the stock trading hours in the New York Stock Exchange, 9:30 a.m. to 4 p.m. East Coast time. For futures, I personally use TD Ameritrade. Feel free to use any other company that you prefer. I'm just telling people, if you're interested in that, those would be good things to start setting up now, a few weeks ahead of time, so that you could be ready if you were interested in this sort of short-term trading on the side. Now, I do believe that the gains that are going to become for the physical metals are going to be significant. Later on, we will look at the ratio that has been presented in the U.S. debt clock. There have been some questions about that show that the price of gold, for example, could be above $7,000 an ounce. And I wanted to look at some of the possibilities for that, for the physical metal, which would be a tremendous move for the physical metal. So once again, I do not encourage everyone to do short-term trading. I think it all depends on the individual, as I said in the last video a week ago. But I am trying to help people who would like to do that thing over the short run and perhaps use those profits to buy more of the physical metal or for any other thing that you see best. We're looking at gold here over the last 3 days. The weakness that I was anticipating last week materializing a bit further here. There's nothing that makes me anxious at this point about the action in gold. Everything looks very nice from the consolidation standpoint that we are looking at. Flipping this over to silver, also coming back down off of the upper 17s back into the low 17s. I did not trade this move lower. It was not appropriate for that. It just didn't move quickly enough for that sort of a trade. So I did not do that. I am watching this right now play out. Now, when we look at the gold market here over the 1.5-year time frame, and for anyone who is new, we're looking at the spot price of gold in US dollars per ounce. Of course, gold trades in every currency worldwide, and there's different things going on in different currencies, but we are looking at what is still considered the world's reserve currency and the currency that gold is traded on internationally. So we are looking at that over the last 18 months since the beginning of 2015. And we can see the surge that we've had. If you have just finished watching the last video where we did the long-term overview, here we are now looking into the medium term, as I would call it, the year and a half time frame. After the surge that we had in December, and we're seeing this up and down consolidation after that surge. Now, the break above this resistance zone from early 2015 that was attempted just a few days ago and has since fallen back. This constitutes, in the technical analysis that I do, this constitutes a false breakout. So this was something that went out to my premium subscribers in the last weekend update. And I'm just going to share this bit of analysis because I think it's very important. And what do we mean by a false breakout here? Well, basically that's where the price of a commodity or a stock, gold in this case, spikes above the resistance zone that we've been paying attention to, this zone right here, right around 1305, 1306. It spikes above and then quickly reverses back down. So it fakes everyone out and then comes back down into the previous zone. Now, before I get into what I believe will be the ramifications of this false breakout, I want to show you another example of a false breakout, and we'll come back to this in gold, but we're looking at silver. I'm going to switch over to silver. Again, 18-month time frame. Now, rewind, if you've been with me for the better part of the last year, rewind in your minds back to late October. Silver had a false breakout right here. You can see this line up above the blue turquoise line, this shot higher, and a quick reversal lower. Now, this was a false breakout above a declining trend line. And what did that lead to? After the false breakout, it led to a rather precipitous decline over the course of the next 4 to 6 weeks, making a new low. So it basically just fell straight every day for 2 or 3 weeks. And I remember people back then saying, when is this going to stop falling? And we were all trying our best to gauge the bottom when that was going to occur. My point here is that these false breakouts can be rather serious events when they occur. It's been my observation that about 1 out of 3 breakouts across most markets will become a false breakout in this way. Now, here's the key difference between the silver false breakout and what we are seeing in gold currently. This false breakout from silver back at the end of 2015 was happening still in a bear market, still in a downtrend. So when you have a false breakout that occurs while a market is still in a bear market, a downtrend, this often leads to a new low for the move. Also, I would say that when there is a false breakout after years and years of gains, that can be the signal for a long-term top, the end of a bull market, for example. We saw that in 2011 in the gold market, and especially in some of the gold mining equities in September of 2011. A lot of them made false breakouts. And that basically began 5 years of declines. I remember that period very well. So what is the difference between this, and why are we saying that gold, switching back to gold, is not going to see, for example, 5 years of declines after this false breakout? What is different about this? The difference is gold has entered a new bull market. And that might seem like just words, but we're really basing that on the technical analysis that we've been studying in all of these videos over the last several months. We were noting the break of this downtrend channel, the 2.5-year downtrend channel shown right here in February. That was an important break. We've been noting that the gold miners, which tend to lead the price of the metal, are significantly above this reaction high, where gold is still below it right now. So that's another signal. We noted on our long-term charts some of the real excellent Fibonacci retracement levels that gold hit in coming back from 1900 all the way down to 1045 here in December, getting close to that 50% Fibonacci retracement level of the entire bull market, followed by this impulsive move higher. So when you take a lot of these signals as a whole here, gold outperforming the bulk of commodities even as it was moving lower, you take the confluence of these signals and you say, okay, so yes, we had a false breakout. False breakout clearly represented a short-term top to some extent, but is this a top that is going to lead to years and years of declines further. I do not believe so. So what are we looking at here? We are looking at what essentially is going on 5 months now of consolidation above an important break of a downtrend. Gold is right now very clearly in between this resistance zone and this support zone. So what tends to happen, and I'm never saying that when I talk about technical analysis that it is 100%, because no form of analysis is. But from my observations, what I've been using to trade and to invest and what I've seen across these markets that I've been observing is that when a false breakout happens in the beginning phase of a consolidation in a new bull market, it means that the market just needs some more time further to consolidate. And yes, that's a little bit vague, but it generally just means that the market needs to come back into the support zone. It could be down into the lower end of the support zone. It could be into the middle of the support zone here in the mid 1200s. We have a very nice uptrend line here. 1, 2, 3, the fourth hit coming just a few weeks ago, so it wouldn't surprise me to perhaps see that act as the support in the 1245, 1240 region in the next couple of weeks. I don't know. I'm not trading gold short term right now because I don't see a setup to trade. I'm stepping back and I'm saying this is a consolidation, and I'm positioning myself for when the consolidation is going to move to the upside with my long-term investments, which are in the gold mining complex. So I'm stepping back and I'm watching this now, and I'm saying another piece of data that we have coming in is looking at the seasonality. So we're looking at this chart, courtesy found in the public domain of my friends at the Casey Research organization. And we're looking at the seasonality for gold over the last 30 some odd years. And we note that we are in the slowest time period right now, June, basically late April, May, June, through kind of most of July is the slowest time period for gold. So if gold is consolidating during this, the weakest time period, it gives me another piece of data here that's saying what is going to happen when we get into the strong season, which starts sometime in August. Certain years it's early August, certain years it's late August or early September. You can see September here being the single strongest month for gold from most of the data that we have available to us, continuing into October and basically continuing through February of the following year. So we have the strong season coming up here for gold. So we move that back down and we say, if gold can consolidate continuously like this through July, perhaps hit this line, perhaps it even breaks this line and fakes us out, bounces again in our support zone, I think we are setting up very, very well to break the resistance zone for good at 1305 late this summer, early in the fall. I believe silver will be following in gold's footsteps, but it might lag. So the corresponding high for silver between that $18 and $18.75 price zone, if gold breaks 1305 in August or September, who knows? Maybe silver will even wait until October, November, or December. But that will be fine because that will give us plenty of warning time to set up for an excellent short-term trade if we are so inclined to do that. And if not, it will give us a very strong confidence level if we want to continue stacking. It will give us a very strong confidence level if we see gold breaking above 1305 for good and starting to accelerate. So I had a few questions about something that has popped up recently in the news. There have been a few articles about this, and I just wanted to explain my take on this here. This is the usdebtclock.org. And this is a pretty interesting website that looks pretty complex, but it provides a lot of fascinating data as to the U.S. national debt and, the debt per citizen, a lot of other incredible stats here. But the thing that has been brought to my attention is they added this new section here down in the lower right, and I'm going to zoom that in so we can see it. Basically what they've done is they've added a dollar to gold ratio, a dollar to silver ratio, and they're giving that at gold over $7,000 per ounce and silver over $800 per ounce. And they're comparing that to the figures in 1913 at the founding of the Federal Reserve Central Bank in the United States, 28 and 264 respectively. So the question is, where are they getting these numbers from? And what do I think of these numbers? Are these legitimate numbers? Well, first of all, as you know, I tend to stay away from the extremist types of viewpoints with regard to the trajectories of the metals. As you know, I don't believe silver is going to triple digits this year, nor do I believe gold is going to $5,000 this year. And I would encourage you to make note of the people who are trying to sell you extremist type of rhetoric like that. And if those predictions do or do not come true, I would encourage you to adjust who you listen to going forward. I do not think the metals will be moving along that trajectory, but I do believe they will be moving significantly higher over the next number of years to come. What about these figures here? Where are they getting this from? This gets a little bit in depth, but I'm going to summarize it as quickly as I can. They are deriving this figure from the extrapolation of the M2 money stock that is published by the Federal Reserve. Now, there are M0, M1, M2, and there are actually M3 definitions for money stock. And these include different forms of money, not just the currency, the dollar bills that we hold and the coins that we hold, but also money that is sitting in checking accounts, savings accounts, money market accounts, mortgages, bonds, all these other things. And that is included in the M2 definition. The M1 definition includes fewer items, and the M3 definition includes even more items. Now, on a side note, the Fed has actually stopped publishing the M3 figure as of 2006, claiming it was too expensive for them to publish that figure, which is pretty ironic considering this is an agency that prints money out of thin air, basically saying that they could not print enough money to cover the cost of monitoring their own printing. But I will come back to the question at hand, which is, what do I think of this number? So they're basing this on the M2 calculation. This is the M2 money stock from the Fed site. If you look here in 1980, M2 was below $2 trillion, and now M2 is approaching $13 trillion. So this is over a six-fold increase, or 500% increase. So basically what they're doing for this site is they're saying, well, if the price of gold, for example, in 1980 hit $850 an ounce, and now there's a six-fold increase, let's multiply that out based on the number of dollars, and we'll come up with this figure. Or in this case, based on the number of dollars since 1913, which I could not find that data for. This is an interesting comparison. Do I believe that this price is possible for the future? Yes, I actually do. I don't think it will be this year or next year or even through the remainder of this decade, but perhaps at some point in the next decade, especially if we are looking at some of the other metrics that I follow, such as the Dow to gold ratio, which typically hits a 1-to-1 ratio at a precious metals peak. And you think, well, gold is now at 1260 and the Dow is over 18,000. What if the Dow comes back down and falls to, say, 7,000 and gold rises to 7,000? That would get us to that 1-to-1 ratio. So I do think that could happen. However, I think the publishing of it in this way is a little bit misleading. There are many ways to value gold. We can value gold against the number of M2 money stock, but then again, we should value the gold against M3 money stock, which they are not doing on this website. As I said before, we could also value gold against the Dow. As we know here, we could value gold against silver. So why aren't they publishing that ratio? We could also value gold. How many loaves of bread can we buy for an ounce of gold? House prices to an ounce of gold. So all I'm saying here is, could I foresee this figure at some point, perhaps in the next 10 years? Yes. But I do feel that this is misleading for them to just publish this as fact and to leave out all the other ways that we could and we should value gold. In summary, we are looking at the support and resistance lines that have not changed for the last 2 weeks for gold and for silver, respectively. And we are seeing the leadership provided by the gold and silver mining sector. We take all of these things together, and I believe we are setting up for a strong fall ahead. Thank you again for watching. I will see you this time next week. Have a nice night.